Well, I think there are people that are willing to walk a line. Just as I think there are people that are still not even complying with securities laws when they invite people in to aggregate money, when a large chunk of the people that are venturing together are passive and only have an expectation of a return. They've essentially been sold a security, and therefore you need an exemption or you need to be regulated, directly by the FTC. So thinking about this a little bit more, at the end of the day, what is really different between the co-GP structure where you have 12 co-GPs, capital raisers raising for the same deal, and then you restructure it as they each have their own fund and they're cutting a check? There are some structural differences, but at the end of the day, are there, what really are the differences?
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube series, The Allocator, a new way to invest in real estate, all about this new world of capital, the capital allocator. Now, Franklin Spees is my guest today. Franklin is an attorney, or has an attorney's background, but he also has a lot of real estate experience. He is a capital allocator, amongst other things. And so you're going to hear through his lens, and he's very careful to specifically say he's not a securities lawyer and he doesn't give any investment advice or any kind of legal advice, I should say, in the podcast. But he has some deep insights into the world of syndication, of the capital allocator, of the fund of fund models, and everything related to this new industry. So he's an interesting fellow. You'll enjoy the conversation. If you want to know more about Franklin, go to GowerCrowd.com and find the podcast page. I'll include links to his LinkedIn profile, to his website over there. And while you are there, working from home as I am, while you are there, be sure to subscribe to my newsletter. It comes out every week, and I cover all aspects of real estate and investments and finance for investors, passive investors, for sponsors, raising capital, and some ancillary really cool stuff on AI in real estate, as well as currently a fairly strong focus on building networks on LinkedIn. So some really cool, interesting stuff there, all at GowerCrowd.com. Okay, enough of that. Let's move over to Franklin Spees. Here he is. Franklin, what a pleasure meeting you. Thanks so much for joining me today. Let's start at the very top. As you know, I'm interested in learning as much as possible as I can about the capital allocator model in real estate syndications, or in real estate, commercial real estate. So let's start with this at the very top. In that context, what do you do for a living? How do you make money?
Okay. Well, this sort of leads me towards the allocator role that I have. But backing up, I started in the area of law. So I came out of college and went to law school down in San Diego. And when I exited that, similar to you, my world has been around real estate my entire life. And so even in college, I was an RA. So I met my wife in college. We were RAs in college together. And then when we went down to San Diego, my grandparents owned some real estate and they had us manage an apartment complex, and moved into some condo conversions, and worked at a law firm doing some municipal law and real estate law. Quickly realized I didn't want to be in a law firm for the rest of my life. And I got a broker's license and went out and did some land use entitlement work. And that really led me towards some other entitlement work with commercial companies, large retailers like Home Depots and Walmarts. We did a lot of site development out in the Western states. Again, all within the world of real estate. We started a property management company in San Diego, and then I shifted back to where I live, where I grew up, which is in Central California in the Clovis, Fresno area, Fresno County, and went and worked at the city as a city planner, as a planning manager for about 6 years working.
You went to the dark side.
Yes. Well, I had to, keep your enemies close, right? So then when I was there, my wife here, as she had young children, we started a property management company, and that started to grow organically. And then eventually I stepped out of the city, went back to practicing some law, became a VP of a firm. And then the management company continued to grow. And that sort of leads us up to, when you reach a certain part in your career, you've got some excess income and you want to start investing that and growing long-term wealth. Well, where am I putting my dollars is really where it starts, right? That's where the alignment is and all this stuff related to an allocator, I believe. And so we bought our, single family homes and duplexes and fourplexes and some various smaller properties. And then you just start to compare returns. And then you look at the S&P, you look at traditional investments. And there came a point at which I said, you know what? I've got multiple people coming to me because I was a broker as well. So I've got management clients, a whole bunch of management clients. So I manage a portfolio of properties here in Fresno County. And they were saying, hey, can you help me either sell this asset or acquire a new asset? I want to grow my portfolio. And so absolutely, I would do that. And but then you start to compare those returns and how active those investments are to a commercial investment in a scaled up larger complex. And maybe that a handful of people joint venturing and buying a 8-plex or a 16-plex or a 40-plex and see where that goes. Well, I had another colleague of mine here locally who had a lot more horsepower than I did. And I said, hey, why don't we, go after a 50 or 80 unit building and raise some capital, family and friends, and then let's put some money into it. And basically I was thinking that I'm inventing the value add model, which has been around forever.
Dangerous love that.
Yeah.
It like suddenly had original thought and then discovered everybody's been doing it for generations. Yeah.
That's right. That's right. And they were in the affordable housing space and they had done a bunch of LIHTC stuff, thousands of units, the generation before him. And so he thought, hey, this is great. Get us into the private market side. Let's do it. And so we started hunting for 50 or 80 unit apartment complex. And lo and behold, the best thing that came across our desk was a $46 million, 450 door portfolio in the valley here, all within like 45 minutes of our house. And it was like a 12 to $13 million raise. And for whatever reason, we said, let's do it. So that put us in a fundraising mode and we're syndicating capital. And of course, that's the intro to securities laws and operating agreements and lenders and everything, and going hard, $500,000 in 30 days and $500,000 more in 60 days. Long story short, we ended up partnering with not only the management company, but institutional dollars who came in and we raised the money, and that was a home run. So that was 2017, 18 that we acquired it. And you didn't have to be brilliant to get in the market at that point for it to just skyrocket, right? It was a grand slam. I mean, for me, it was, 8, 9, 10xing dollars over the next, 5 years, maybe to never be seen again. It was amazing. It was an amazing way to start, but that spurred off a couple of different things. And that was a group that I helped to form, which is called Ideal Capital. And that's here locally. And they're still going, and they're pushing $2 billion under management. And so ultimately what I did is I sort of pulled back because I still was practicing some law. We have a property management company. And we're managing larger properties as well, 150 units, 100 units, 96 units. And so I've got all these hats that I'm wearing, and I'm realizing that in this allocator space, I am better as a partner in a deal, having been a property manager, having been a real estate attorney, having invested in my own properties, and all these different hats come together. And so I found myself sort of had this competitive, call it a niche or advantage, is I can add value to a team, but I don't want to start up my own, becoming a lead sponsor or an operator, right? And I didn't want the brick and mortar office where I've got construction managers, asset managers, attorneys, all of this. I got a payroll basically, and I need 3, 4, 5 deals a year to get those acquisition fees to keep that engine running because it's hungry, no matter what the market's doing, and specializing in likely something. So I said, I don't want to be a part of this group. I want to partner with this group as an allocator. So whether that be a co-GP, a co-sponsor, creating my own fund, But I also then started building these relationships with other sponsors across the country in other geographies with different profiles as far as companies, different scales. And, um, and that allowed me to really find and build relationships with the best sponsors across the country and then cherry pick their best deals based on my timing.
Okay, so let's drill down on that a little bit.
Sure.
First of all, let me back up to this idea of co-GP. So now we've stepped into the capital allocator world. You've got a lot of experience. You've got some hands-on experience, which is unusual, frankly, in that world. And you find a sponsor. We'll talk about that in a second. But let's talk about the structure. So, what is the relationship? What is the legal relationship that you have with a sponsor when you when your role is to bring capital to them? What does that look like? What are the different options that you might have?
And you're not going to like this answer, but I'm going to say it depends. And the reason for that is, for example, that original deal that I talked about, I was legitimately a GP. I'm in the GP and that entity, and then we go out and raise capital, but I'm sharing a percentage of the profits of the whole deal, right? The GP stake or all the upside. I'm sharing a percentage of that, and I'm an issuer in the eyes of the SEC, right? Now you can step back from that and become, other people would call it a co-GP, and that was blurry. It's been blurry over the last handful of years.
Hasn't it? That's exactly what I'm asking. And by the way, when you say it depends, trust me, I know exactly.
Yes.
Oh, I was.
Yeah.
So this is the puzzle I'm trying to unwrap here. So go on.
That's right. That's right. And to preface all this, although I'm an attorney, I'm not your attorney, listener, and I'm also not a securities attorney.
Okay, so that is very important because securities is a very sophisticated, very specialized area, but you know enough.
Yes.
By an SRE to know what
to stay out of trouble, I think. Yes. So then you find yourself in this position potentially where you are a co-GP with a sponsor. You're helping them to raise capital, but I would always, one, invest in the deal, two, go out and do my own due diligence, either alongside them, or even if it's redundant after the fact, and go retrace their steps, fly out to the property, go meet with the management company, drive the neighborhood, look at the comps, look at the CapEx plan, look at all that stuff, doing it to satisfy myself. And when I say that, I really mean my wife. And so if it's good enough for me, then I turn to my network and I say, hey, I'm investing in this deal. You already know, like, and trust me because I'm either your attorney or I'm, managing one of your properties. And so that's how that worked. But then you find yourself in a spot where, wait a second, I'm one of 11 co-GPs in this deal. How does that look?
How does that? Okay, so really, so hang on. Let's just step back one step.
Yeah.
So now you're talking to this GP, and by the way, you've actually made a really interesting distinction here. That in the eyes of the SEC, this is something that is really confusing, has become confusing with this whole allocator thing, is people will say, yes, I'm a GP, I'm a co-GP, as though they are the principal, but they are not the principal. So I've been struggling to try and find, how do you actually ask the question to get a yes or no answer? And I think that you've hit the nail on the head. Number one, does the SEC think you're the issuer? Right. Number one, is that you? But also, you said not just the issuer. Yes, the idea that came to me was that who decides how to share the GP economics?
Yeah.
Who is the decision maker on that? Is that you? If the answer is no, you are not the principal. So that actually is a very interesting insight that I appreciate you giving me, because I've been really struggling to try and get to that yes or no answer. All right, so now you go to a GP. Actually, I mean, let's call them the sponsor for the term.
Yes,
right? It's
yes.
the sponsor, right? Person who does decide how the promote is split. And before you discover that they have 20 GPs, what's your conversation with them?
Yeah. Well, it typically starts with the relationship that I have with the sponsor, and then the deal that comes across my desk, and then um, once you have a relationship with them, they're contacting you typically saying, "Hey, we've got another deal," and then you go in and you deep dive. They usually send you a data room.
I'm going to get beyond the due diligence. What I'm asking,
Okay.
so what?
Okay.
So you've got a deal, and you're going to bring some capital. Let's call it, for argument's sake, $50 million deal, $20 million total raise, and you're able to bring, like, how much would be an average raise for you on a deal?
Yeah, call it a couple million.
So 2 million.
3 million.
Million.
Yep.
How much?
Yeah. So yeah, call it 2 million.
2 million. So you go to me, so I can bring you 2 million, but you ask them, okay, your deal is a 70 over an 8, for argument's sake, right? 70% split to an 8% over an 8% pref, and they may have some other tiers. What you're going to say to them is, I'm going to bring you 2 million, not 50,000, which is your minimum.
Right.
What terms can you offer me? I'm putting words into your mouth, but that's what I'm getting.
Yeah.
What's your conversation, and what kind of structures have you seen?
Yeah. And I will say multiple structures depending upon the sponsor, and depending upon their level of comfort with their interpretation or their attorney's interpretation of the SEC laws, and broker dealer and compensation being correlated to how much you raised. At what point do you have that conversation? Is there a formal calculation, or is it a general understanding, or do they group it within? Yeah, maybe I tell them, I think I'm going to bring $1 million to $2 million to you, and then I'm also going to be doing these things too, which is, again, being part of the due diligence or being on asset management calls going forward, and so you package all that together. And is it a side letter that comes in on the deal? Is it a co-GP where you're actually a member of that LLC, or is it something else, some iteration of that? Or maybe it's a boost in the returns that are on my money that's invested in the deal. And then are you participating in the acquisition fee, the asset management fee, the disposition fee? There's a refi fee. There's what I mean, where are you participating? And that's all over the board, right? It just really depends. So then you kind of step back to that and you say, well, what is a general expectation of what I believe the effort that I'm putting in and the value that I'm adding to the team? What is worth my time, rather than let them sort of dictate what it is. I have to predetermine that. And then that's how I basically approach that. And it's somewhat negotiable, but pretty much you see in every syndication, a sponsor will generally allocate about 30% of their GP upside going towards folks that are going to come in and help them to raise capital, amongst other things. Right? Who could in decided? Yeah.
Sorry, Franklin, I did mean to cut you off.
No, go for it. Keep going. Keep going.
Apologize. Sorry, I didn't mean to cut you off, but I did. So again, being cynical, actually, a little bit. What else are you going to provide, BIT, to this party in return for your co-GP position?
Yeah.
Is largely an accommodation of SEC regulations, isn't it? I know you're not a securities attorney.
So I would say it can be on some, it can be on some that it's not. I'll give you two examples. There was a deal that I raised for where they were a very well-established sponsor. They're very present in one particular market in the South and one specific type of, value add multifamily in this region, and they're vertically integrated. And they've done this, and this is just like a rinse and repeat thing, and they're really good at what they do, and they've got a great track record. Well, those guys need me less, let's just say, right? Then I'll take another example where here locally, about 40 minutes north of me in a small city, I partner with a couple of other, a GP, and I came on as a co-GP, and they needed some additional capacity. So we are actually doing a new construction in industrial multi-bay, right? So I was involved early as a part of the acquisition. reviewing the purchase agreement. I was involved early as I did the actual land use entitlements and taking the site plan review to the city to get it approved by the planning commission. I reviewed construction contracts. We were there and seeing the construction going up, and there was reviewing the lease and all the way up through the financing. And we're still through that. Now we're at 95% occupancy.
Okay, so that's clearly, you know, where you are. You clearly active. But in this example that you gave me, of a shop where you went in to a sponsor, and there's 20 co-GPs. So obviously there's something else going on there. But the relationship that you have with the sponsor, but also it would be for your 2 million, back to this example, for your 2 million or 10% of the 20 million that's being raised, this would you would cut preferential terms, right? So instead of a 70 over an 8, for example, you might negotiate 80 over a 10, for example. Is that right? Is that how you've raised 25 million? I mean, according to your website, 5 million.
Yeah,
Is that how you?
It's about 30 now that I've raised, and I would say it's so deal by deal. It really is. That what you just described is definitely one way to do it. And I'd say moving from this scenario to what is now, you were probably leading towards this, is moving towards what is more industry accepted, and everybody's moving that direction, which, because it's likely more compliant, it is more compliant, is the fund to fund structure. And in that scenario, and I listened to your recent podcast, I think Jeff Greenberg was on, and very similar in some of the things that he does and how he structures it. But yes, you're going in and negotiating with these lead sponsors and saying, if I cut a single check to you, so that's another thing, right? If I create a fund and I go out and raise from 20 different investors, and then I cut a single check to you as a sponsor, well, now that's a single K1 to me and a single check to receive. And you're just talking to me. You're not talking to these 20 people. Boy, that just made your life easier, right? So there's a huge value for me to come in as a $2 million check. And then I have the responsibility to, manage that communication, make sure they're getting communication. And I'm taking on some, customer relation or investor relations role with that. But I also am not introducing my whole network to the sponsor.
But the fund of fund model it still requires a conversation with GPs to get preferential terms, doesn't it?
It does. And that I think is the very healthy, market driven competition. I like that incentive structure, because I can legitimately say my fund wants to negotiate a better upside, one, for my investors, but also for myself too. Like if one particular sponsor comes in and says, I'll give you, an increased prep, you personally, for the $2 million check, I'll give you an increased prep. It was going to be a 7, and for you, it's going to be a 9 or something like that. Or some other competitive split. Well, I can take that margin, that delta, that arbitrage, and I can use that to fund me, to incentivize me. Whereas the person, as they say, the person that's coming in, that if they were to find a sponsor off the street, they'd be getting exactly the same terms. If they could find them for one and do all the due diligence and decide that's the one, they're going to get the same, if not better terms going with me than if they were to walk in off the street, right?
So are those the structures that you've done? Is that how you've done it then with your 30 million that you've raised? Is that where you've negotiated preferential terms, and then what? You either pass that straight through to investors, presumably not, or you harvest it for your own compensation, or you split it somehow. So how typically do you do it?
I would say all of those are options that we have done and I have done, depending. And I think it will continue to change. Now, think about this too. There's only so many fees that you can charge. Slap a name on it, put a timing on it, wherever it is, on a deal, soup to nut, there's only so many fees that are tolerable by the investor, right? And so I think that's one way to look at it too, is that there's a reasonableness standard in the fees that they are expecting to get. There's a reasonableness standard that my fund is going to be feed by the lead sponsor. And the investor certainly doesn't want to feel the double ding of fees up the chain, right? So all of that's considered, but we're really in the business of providing those competitive advantages of access, of, getting around minimums, being aware of projects in general, leveraging the relationships and certainly the due diligence, and, moving towards one of the things that we're now doing. And this will be the second iteration for me and maybe the third or fourth for my colleague. We're forming a fund at the moment as we speak, and this is going to be a diversified fund, and it's going to have 8 to 12 low or uncorrelated assets within it, sort of that Ray Dalio approach where you're maximizing returns, stable returns. We're not swinging for the fences. We're also mitigating risk, and we're adding diversification for a longer period of time. And when I say longer, I mean 5 to 7 years. And in that model, we are providing what we believe to be a competitive advantage for those investors who come in, and everything isn't riding on the rise and fall of one particular asset, even asset class or sponsor. It's dispersed around all sorts.
Yeah, diversification. Right.
Yes, all within one fund, I guess is my point. Yeah.
And the fund will, so somebody will, just because there's this fund of whatever, customizable fund kind of structures where you've heard about. But the way that you're structuring it is traditional fund structure. Somebody invests, they own the fund, you decide what goes into the fund, and the aggregate of the results of everything that happens inside the fund is what they will take a pro rata share of.
That is what we've done in the past. And that is what we will continue to do, in addition to one-off deals, one-off syndications, in addition to joint ventures. I mean, I just closed on a 50,000 square foot industrial property, about 10 minutes from here with two other guys, because that made sense to me, in this particular market. But yes, to your original point, yes, we will create a fund, and it will have a certain target, and the private placement memo and the subscription agreement will describe a particular fund. It won't be blind. It won't be open as an evergreen fund. But I say that because we're also now in discussions and looking for these larger check writers, these larger partners, whether they be an investment advisor or a sports agency or other high net worth individuals, where we have the ability to, and I put that on my website, is that create a customizable fund where we can say, these are the funds that we've done. Here's the 3 iterations. In fact, here's even one that's available now. But if there's something that your particular group is looking to emphasize more, whether that be cash flow or a shorter illiquidity period or tax mitigation or one particular asset class, or trying to avoid a particular type of asset class, we can create a white glove or a customized model for them. And again, that would be prepackaged, because we are being very careful not to be the advisor, but we are the facilitator and ultimately the fund manager, catering to the needs of our investing clients.
So you talked about working with large sponsors, and again, I'm still not entirely clear on how you've structured it. But you've raised 30 million. You've allocated that money to some larger sponsors, right? You've invested in your website, I think, says it is mercifully actually clear what you say here, which is very different from what I do see elsewhere. It's staggering what people say. I think, we go. Investor capital raised and deployed 25 million, 30. The commercial asset value is $1 billion. So it's clear that you've raised money and that's what you do, right, over there. But you said that you've seen some sponsors that have, 10, 20 co-GPs. What does that tell you about what's going on over there?
Well, I think there are people that are willing to walk a line. Just as I think there are people that are still not even complying with securities laws when they invite people in to aggregate money, when a large chunk of the people that are venturing together are passive and only have an expectation of a return. They've essentially been sold a security, and therefore you need an exemption or you need to be regulated, directly by the SEC.
Right, you do. In what way are they non-compliant? What exactly are they doing that is non-compliant?
So don't take this as legal advice, but my understanding of the law is that the second at which you're offering a security. So as you know, when you buy into a syndication, when an investor buys into a syndication, they are not buying a real property asset. They're not buying an interest into real property. They're buying an interest into the entity, which is personal property. And the sale of that is a security. Any way you slice it, you're buying a security, right? And so, what was your original question?
Yes. So how are people non-compliant? You said that people are non-compliant.
Yes.
What are they
So,
actually doing that is non-compliant?
so really, it's the registering with for an exemption, right, under Reg D, typically a 506B and C in my world. And what they're not doing is, as a part of that exemption, there's certain filings, and then there's also disclosures and the structure. So disclosure is the big part of it, right? So the private placement memo, the subscription agreement, all the information that's in there that basically tells them if this is a a forward looking speculative, high risk, all of these things could happen poorly and you could lose everything. I mean, these are the types of things that the consumer should be protected from when they go into investment, rather than just, I can trust me, you cut me a check. And what I'm saying is that if I have 20 people helping me to buy that same industrial property I just described, 3 of us are really going to be active day to day. And the other 17 are doctors, attorneys, and dentists. And they're just coming to us saying, hey, how's our deal doing? Where's my return? Those folks were entitled to certain disclosures and protections as it relates to security.
Right. But the co-GPs, you said you've seen some sponsors with 10 or 20 co-GPs. Those folk, that's okay. So that's really strange, right? Where you're going out and you've got 10 allocators coming to the same sponsor and the sponsor's cutting different deals with each one of those. I thought that's what you were alluding to when you said you've seen 20 co-GPs. So each one of those people is going out soliciting from investors and funneling money into this one sponsor.
Yes. So thinking about this a little bit more, at the end of the day, what is really different between the co-GP structure where you have 12 co-GPs, capital raisers raising for the same deal, and then you restructure it as they each have their own fund and they're cutting a check? There are some structural differences, but at the end of the day, are there, what really are the differences? I think, let's see, I'm speculating that, and this has a lot to do with the new administration, the finders sort of exemption, where there are certain incentives and policies and laws that I think are evolving as we speak, that are trying to encourage capital formation in a very legal and more accessible way, so that people don't have to take risks or try to mitigate or invent new ways to raise capital for deals. So I think it's all going in the right direction. I'm positive about it, but I think the fund to fund model is, at least the big guys and everybody that I'm talking with, is definitely, over the last 24 months, there's been a big shift to that, where you'll see a lot of the sponsors now will set up their own programs to say, hey, we'll pay or subsidize you to create your fund for you, so that you can write that single check, and then everybody's better off, compliance wise.
Well, that's interesting. So of the deals that you've invested in, over what period of time? That 30 million has been deployed over what period of time?
Since about 2017, 2018.
And how many of those are you still in?
Let's see, 5 of those. So of the total deals, it's about 12 or 13, and I'd say 5 to 6 have gone full cycle.
Okay.
And so, yeah, approximately half or just over half, I'm still in.
And how are they doing? The ones that you've invested with other sponsors, basically.
Yeah, wish you would ask that question 24 months ago. No, they are, just as everybody is feeling, the market hit from multiple things, right? And there's even a distinction between new construction, that industrial project that I talked about, and construction rates, construction loan rates, and switch gears and labor, material costs and everything. And then just the typical things that you're hearing where, um, for example, value add multifamily deals, the cash flow, the distributions are either decreasing or even holding um, in a very conservative way, knowing that that return is still accruing for that investor. I think what we're ultimately seeing is a response to the market softening, both in rents and transactional volume. And I think it's going to add some time extension to some of those deals. But I also think that the investors who are partnering with the right people who had been in it years before and will be in it years after, they're in it for the long term. They've got the systems down, they've got the compliance down. They are going to weather the storm, especially those that are vertically integrated and they can control their operational costs. Um, I think the markets are cyclical, of course, and when they recover, I think the downside will be there'll be an extension of that illiquidity period, that hold period, and then there will be a catch up. And the person that's probably going to take the largest hit in that circumstance would be the GP on the back end, having to catch up the LPs before they get paid. But again, it's just part of a natural market cycle, and I think actually that is now turning around, and I'm very optimistic about where things are going at the moment.
Okay, so let me ask a couple of other questions then. So you've raised 30 million. How many investors, approximately?
Uh, Total or an average on each deal?
Yeah, total.
So total, and this sort of gets me to a thought I wanted to bring up with you and your listeners, but
Sure.
I would say on any given deal, if I raise, um, you know, like I raised 5.5 million on a deal, and that was about 25 investors. If I raise about 1 million, I'd say it's somewhere in the ballpark of 10-ish.
Okay.
And then where does my pool come from? I mentioned that one of my just naturally, I sort of fell into this, which is I I have a property management company, and every one of those clients by definition is an investor, right? And they invest in real estate for a return, and they already know, like, and trust me, right? So I have a captive audience of people that know, like, and trust me, that already trust me with one of their greatest assets. And so when I put out a deal, um, alert, let's say, they're interested in at least hearing. I'm not just this, random person that's connected with them on social media or something. And so I guess what I wanted to say was, if there are people out there, and I've actually thought even about purchasing a property management company for the purpose of then running the management company as a loss leader, bringing it into the fold of my portfolio in order to meet all those investors and provide the same benefit that I am to my investors. I've even talked about and am talking with other property management companies that, similar to me, I could partner with them to help them to draw out and raise capital from their, existing portfolio of clients. I think that's a great one. And then there are those that are fund managers that are out there that are already doing that. And, looking, and I think some of your other guests have talked about fund managers working together to then partner up both on due diligence, but also on capital formation, so that you can go and have greater leverage, and be of greater value to these lead sponsors. Instead of I'm writing a $1 or $2 million check to a deal. Well, if I'm partnering with these 5 fund managers, now we're writing a $10 million check, to the deal, and we can negotiate a whole lot more. And it creates a lot of velocity on their capital raising campaign, because they don't want to just raise a deal a year. They want
Right.
5 years, 5 deals a year,
What is the typical? What would you say are the demographics of your investors?
Well,
Like, what's their background? And I didn't get to a final number. I think you said 10 on $1 million, but so
like
how
that.
many? How many then total? Couple 200-300 in total you've got?
Oh, yeah, something like that. Yeah.
Yeah.
I'd say between 250 and 300 active, investing
Right.
clients or interested in.
And what would you say is the demographic? Like, how would you characterize them?
I would say all of them, as I mentioned, are real estate investors. or legal clients or referrals, but I would say pretty much everybody's a real estate investor. I would say the majority are accredited as opposed to just sophisticated. So 506C.
Mhm.
Um, and then I would also say that there's a spectrum on that, because when I originally started, it was, very much retail, mom and pop, sometimes, the elder person who's retired, who maybe was a retired professional and has a retirement account, and they decided to set up a self-directed IRA and put in 50,000 in the deal, right? Well, real quickly, you can get administratively exhausted if you have 20 of those when you're raising $1 million, and they each have all sorts of questions, and they and they call you a lot. And
Yeah, but you know what? Hang on, I'm just going to interrupt you there because there is a way of managing that process.
okay,
Actually, yeah, that's what we do. Well, what my company does is manage that. Our clients don't have that issue.
yeah,
Basically preemptively educate. But we're coming to the end of the track. We can talk about that later.
okay, all right.
And I'm more than happy to actually, because you can avoid that. You can mitigate it significantly. Let me ask you, let me wrap up with some rapid fire questions. We've actually been going much longer than I'd thought. Okay, so Franklin, what's been the hardest lesson you've learned in real estate?
Um, I would say um, patience is one. I would say most recently in the last 24 months is learning how to communicate bad news promptly, and then appreciating the fact that there's usually almost always a positive response to that. The negative response comes when you delay or fear of giving bad news. I think that's probably a lesson that I have had to learn. Yeah.
Sorry, I've had to learn that. It is true, though. Okay, second rapid fire question. In terms of finding investors for your fund or for your syndications, what have you found to be the most effective way of building your investor network?
I'd say, and I mentioned it, having an existing network
Mm.
of in this property management company and legal clients, people who already know, like, and trust. I probably would, I know I would not have been as successful and may not have even stayed in the industry if I had to start from scratch by doing drip campaigns and trying to self promote. And that isn't so much my nature. I love the fact that I am working with people that I already know, and so really my network is growing through referrals through people that I already know. So that's my answer.
Third of five, almost done. If you could go back in time, Franklin, to before you started allocating, what advice would you give yourself?
Mm, mm. Um, I would probably I would have started going to conferences sooner. Um, One in particular, the best ever, which in my world, it's sort of the uh, for me, it's sort of the epicenter of everybody that is like-minded in my world. And so you go and you get energy from other people and you hear about the latest trends, and it sort of broadens your perspective on tools that are available, legal folks that are out there to help, and then making relationships with sponsors. So I started by looking at one sponsor, and then over time, I naturally shifted into multiple. So maybe accelerating that process some, but there's not a whole lot that I would change. I'm not in a hurry, and I'm not trying to build a $2 billion portfolio or become a lead sponsor. I have 3 kids that are all teenagers. I travel in sports all the time. I've got flexibility with a laptop and a cell phone. I could do all my business in a bathroom stall, is where I was telling people. I mean, I like that. I want to preserve that and keep doing that, and scale gradually over time with mitigated risk.
Okay, last two questions. What's the biggest misconception about the capital allocator model or business?
I think I'll go back to the issue of patience. When you go into these deals, I think that the unsavvy or the new greener investor is focusing more on the returns rather than the long-term wealth growth. Um, one of the things that's attractive to me is looking at what I have this chart, this Excel sheet, that if you what does a $50,000 or $100,000 investment do if you made one every other year over the next 10 years and then you stop and you were just reallocating those investment proceeds each time. And the beauty is with ChatGPT, you can go on there, verbalize what I just said. It will create you an interactive calculator to do that. And you could post it as a web page. But I'd say patience in knowing that illiquidity should be 5 to 7 to 10 years, on these deals. And that's what you want, assuming your capital is working harder for you there than even if you got it back and had to pay taxes and redeploy it somewhere else.
All right, last question. Advice to somebody thinking about becoming a capital allocator or fund of fund manager, whatever you want to call it. What advice?
Well, yeah, it's interesting. We are actually in the process of attracting and even converting some existing investors of ours to be capital allocators, because everybody's got a network and everybody's sharing investment advice. This is an industry, as you've heard over and over. It's abundance mindset of abundance rather than scarcity, right? So I truly believe that we all get farther together, and it's not competitive in nature. I come from the brokerage and the legal world where it's all territorial. It's my commission or it's my client. It's adversarial. This is very much open-handed. And hey, if you want to come raise $2 million and couple it with our $4 million, and then we go get a couple other guys, we as a group can get so much farther together. Let me help you set up your own fund of fund. Let me help you give you the emails that we use in order to cultivate your investor client and then ultimately make the introduction. And we share in the profit because there's always another deal. So that's what I love about the industry.
Fascinating. Franklin Spees, founder of IWF, investwithfranklin.com. Thank you for joining me on the podcast today.
Appreciate it, Adam. Good to be here.
All right, that was Franklin Spees of Invest with Franklin, IWF.com or investwithfranklin.com. Thanks for joining me today. I really enjoyed meeting you. I enjoyed our pre-post conversations and also, of course, recording the podcast with you that we just shared. And thank you to dear viewers. Appreciate you joining us today. And if you have not yet done so, please go to GowerCrowd.com, find a podcast page for Franklin for this episode to get more information on Franklin and his website and his LinkedIn page. And also, please subscribe to the newsletter there. It's totally free. Covers every aspect of real estate investment and finance that you can imagine, including some cool stuff on AI and building your network on LinkedIn and some other good stuff there. All right, all at GowerCrowd.com. All right, that's it for this week. Thank you so much for joining me. Until next time, this is Adam Gower signing off.